So good morning, everyone. Very nice to meet you all. And I'm Filippo Guerzoni, a portfolio manager of High Income Team. And today I'm here for Horizon Capital, maybe not super not company, but actually he is Intesa Sanpaolo Group Asset Management, and he is one of the biggest asset management in Italy, more than 500 billion in asset under management. We, as a Horizon Group, are focused on European products, and in fact, today we want to talk about European bond high yield. We do focus on European, but we do also have some satellite product that we cover. But if you have any more interest, we do have also a line that is our sales here. Okay, so what we want to talk about today? Today we want to talk about searching alpha in fixed income, especially in high yield and credit markets. We want to give you an introduction on credit market, especially in high yield market, our outlook for this year, and then going in depth with our flagship fund, that is Horizon Fund Bond High Yield. So please feel free to interrupt me for any question or at the end of the speech, as you prefer. We want to start directly with why to invest in credit market for this year. So today I want to give you a little bit of fresh insight for high yield space and credit market, and we are constructive. We think the outlook is favorable for credit market for this year, especially for three main reasons. Actually, 4 reasons, but the fourth is hidden. Three main reasons are, first of all, strong market fundamentals. This is very important for us. Maybe it's the most important one because corporates have still a solid balance sheet for our analysis. The cash level is still adequate, high, and we do not have imminent maturity wall. Then I will go in a little bit more depth for all these aspects. Last but not least, talking about fundamental, the default rate is still in line with historical average, and this is very positive. What about the yields and the yield positioning? We think that yield is generally appealing right now. Spread, you could argue that is a little bit stretched, but still compensate adequately for the risk that you have in this market. And last but not least, carry is elevated, is high, and still attract a lot of interest from investor. Last is technical factor. We have seen, probably you know, that last year a technical factor was one of the main reasons that support the market in a high yield space. Still, this year we think could be still very positive for technical because we have strong capital inflow in the asset class. We will show it later in a better way. A lot of buy and watch investors that want to hold the asset class for a long period, and a favorable dynamic of refinancing. I said before 4 factors because we do also have macro. Of course, if we are positive, we think also that macro environment is still supportive for the asset class, and this is because just for easing inflation, also accommodative monetary policy, and we think the credit cycle and economic cycle will continue in the near future. So let's go in more detail about the economic market right now. Let's start with yield. Okay, you could argue that spread could be came back in the recent past. Same things with yield. We can see here in this line, you have the with the yellow line the yield of euro high yield market. It came back in the last 2 years, but still there is value here. We show with dotted line the long-term average of yield, and still we are above this line. We think that the market could go through this line, so yield could improve, but also not just go there, but could also go lower, so positive for the high space. You can see it, for example, for 81 COCO bonds. This yield of 81, that is the, let's say, highest beta asset class inside of banks, came back and now is kind of lower the long-term average, but still is one of the best market in credit this year and also last year. So this could go lower and could improve even further. This is our idea. We are positive for also, not just for high yield, but also for 81 and also for investment grade. But I will show you later, we do prefer high yield and 81 in this context. So another interesting point that maybe is not very shown in, let's say, in other presentation or all around, is the composition of yield. This is an interesting chart that we replicate, putting a little bit of effort at what it shows. It shows the composition of total return in high yield market since, let's say, 15 years. Since 15 years, the market of high yield gained kind of 120, 130%. But what about the composition of this return? This composition, you could imagine that most of the return could be price. No, in high yield, the most of part of the total return is given by income return. That is this yellow part. That is not nothing else but carry. This is the carry of the high yield, and this is the price return of high yield. What tell us this chart? This chart tell us that high yield give you a lot of resilience in all type of market, because you don't have just movement in price, but you have the part of carry that reward you during longer period. And this is interesting for us because we do look at the company that give us long income return because of high carry. Okay. So speaking about technical and fundamentals, we have this slide with a lot of concepts all together, and I want to show you because give us a lot of useful information. Starting from maturity wall, could be a simple chart. Maybe you show around in other presentation, but we put a lot of effort to build this chart because doesn't give us just the maturity profile of bond, of high yield bond space, but what we added is the loan part. That is the light blue column. Why? To have the full spectrum of the maturity wall of all the company in the Euro space. So putting all together, we have a very in-depth view of the market. What tell this chart to us? 26 and 27, the total amount of bond and loans that are going to mature is quite small. So doesn't give any concern to the market. When it will come a bigger size of mature, so bond that they are maturing in 28 and 29, it increase a lot. But this is positive because for the next 2 years, company don't need to rush to refinance in advance. They have still a lot of time. And this is positive. Why? Because on one side, company have the ability to wait because they don't have an imminent maturity wall. On the other side, this give you a touch of the interest of investor in the asset class, because the company had the possibility to refi in advance. So the amount of a bond that mature in 26 already was refi in the last year or 2 years ago. Another aspect is talking about technicals. We said before that technicals is very strong in euro high space. We can saw from this chart, blue line are the inflows of the asset class in Europe during each month. You can see that in the last, let's say, 2 years, we just had positive inflow, apart from this. And what is that? Liberation Day. Liberation Day, when Liberation Month, let's say, when you had outflows, but is interesting because investor were not willing to sell the bond because there was it was difficult to came back after. So liquidity was thin, bid offer was large, so investor didn't exit from the position because after was kind of difficult to came back, and was just an outflow, in fact, that follow a big inflow for kind of not just 1 month, but 3 or more months. This is continuing also at the beginning of this year. We saw a lot of inflow in the asset class, and this, of course, is a big technical factor that support the asset class last year, but could continue also this year. Let's talk about default rate, maybe as an argument and a topic a little bit in the news right now. Default rate, you have here in this chart the default rate provided by rating agency Moody's, both from Europe and the US. Europe default rate is, the exact number is 3.5, and he's here. It rise a little bit recently, but is still kind of in line of historical average. That is 3.3, let's say. On the other side, US default rate historically is a little bit higher because of the composition of the high market. High market is kind of more risky than European market. Why? Because the composition of the index is completely different. You do have a lot higher number of triple C company in the US. So the risk is much higher than Europe, and is you can see it from the default rate. Of course, if the risk is higher, you have a lot of triple C name more than Europe. The default rate is higher. Expectation for default rate, you can see from this dot, from rating agency, are going to decrease in the future, so less default in the company, and is going to go under the historical average for the next year. So still comfortable outlook and comfortable position right now for the market. So we also don't want just to provide you all the good information, but what keep us kind of awake during night. We look at with a lot of attention some micro factors, and here we highlight leverage and coverage. As you probably know better than me, leverage and coverage are two main indicators for looking at high company to find the wealth and situation of a company. Here we put together all the index, all the ratio of the Euro high yield universe to have like an indication of the current environment. And what tell us that net debt to EBITDA, that is the leverage, is kind of low looking at historical level. But recent, in the last 2 quarters, rise a little bit. On the other side, interest coverage, that is the ability to pay the interest by the company, we want a high interest coverage, opposite from leverage. We want low leverage and high interest coverage. We want low leverage and high interest coverage. Interest coverage came back a little bit. And we want this to improve. We don't want it. Yeah, please.
On the net debt to EBITDA, did net debt increase or did EBITDA come down?
It's kind of both. We saw EBITDA actually is not came super down recently, but net debt, the company need to finance a lot. We have a chart later. We can see that a company refi in advance a lot of bond, but also there was new issuance. So they issue a quantitative very large of bond. So the debt is increasing. But actually this kind of situation is increasing, but still very, very low compared to historical average. So the situation right now is still comfortable. We don't want to see this red line to grow and to come back at 2020 level, of course, but neither like because now the level is 3.3. That is kind of historical low. We don't want to reach, like, let's say, 4.5% during historical average. What I want to show you is that we don't want a deterioration of this two ratio, but right now, situation is still under control. You can see from here is another aspect that we don't want to deteriorate. There is a downgrade and upgrade trend. You have 2 lines, with one is with downgrade and the other is upgrade, and then you have the dotted red line that is the ratio between the two. When it deteriorates, it goes skyscraper, like 2020, 2020. As you can see right now, okay, we had some downgrade in the company, but still this ratio is flat. And these aspects are all already placed by the market, are all in the market price, and is not deteriorating this trend. So if this skyscraper, so this will deteriorate. But right now the situation is still under control. This is an aspect that we monitor really careful. If it changes, we probably will change our view. But right now, it's just to show you what is the situation, what could deteriorate, and also what is priced by the market. Okay. Going back to your previous question, what about the primary market? We had a huge primary market, especially last year, 2025. We had one of the highest level of issuance in euro high yield. But actually, most of them were refinancing. This is gross issuance, not net issuance. The difference is that net issuance is company that never came to the market and proposed to the market for the really first time. Gross issuance is they just refi the bond. So already there were already the bond, and they refinancing the bond. Is a very high number, and also this year started very fast. We do have for January 2026 15 billion, 0.7. That is for January historically one of the highest January issuance, in line with 2021. And then we had February that came back. As you can see, all the February after a big issuance in January came a little back. But this high size of primary market is still a positive factor in the market, because as we said before, when we were speaking about maturity wall, company that came in the market have the ability to put a bond and have the ability that investor buy it is a positive sign of the market that is able to absorb all this huge refinancing with kind of no problem. This is give you also the idea that a high-yield investor had a big appetite of primary market, because a lot of time it's kind of difficult to go to the secondary market without paying a high bid offer spread. So that's why you are going to the primary to not paying the spread. And also, if you already had the position before in your portfolio, you just want to roll your position. So primary market, gross supply, still big activity that we had in 2025. We will have probably also during this year, because expectation of company is kind of similar 2025. Please.
Do you also have the numbers of the net issuance?
Yeah, we do have. Actually, total number of gross issuance was 130 for last year. Net issuance was super low, kind of between 10 and 20, because as we previously said, there was not many new company, but was just people that had the big maturity wall that ref in advance. It is still positive, so positive for the market, the newcomers, but we are not talking about big size. Okay, so let's go ahead. We just want to, this is kind of our situation of the market right now. We wanted to summarize right now. And this slide told us, so where are we going from here? We talk about a good environment, kind of good environment for iSpace. Where are we going? So to recap, we had a resilient market. Refi cycle is ongoing. And if you want to look at the market right now, this is the shape of distribution of the yield of the high-yield market. And this is interesting because starting from 3.5% of yield going to 15, of course, you have a distribution that is skewed to the right, with the big part is lower than 4.5%, and then you have tails. So what we highlighted here is that 75% of the bond trade below 5%. So if you buy like the belly of the market is below 5%. Where we think there is value, there is value here in the big part of the market, being very selectively and choosing the best company here, but also not just focusing on that, but what we do also is trying to buy best company in the tails. So company that give you a lot of yield and a lot of reward. And this is kind of our strategy. Now we pass to in our fund, our flagship fund, that is called the Horizon Fund High Yield Bond, and is one of our biggest and well-known strategy in Horizon company. And we want to highlight a little bit how is the situation right now of the fund, how we manage it, our investment process, and then we want to show you where we are overweighted and underweighted, and what we think for the future. So the fund have a benchmark that is highest Bank of America, high yield European issuer, double B, a single B. We do manage against the benchmark, so we do have both short and long position. And our investment process is, of course, top down and bottom up, but we really put a lot of effort and a lot of time in bottom up analysis. And then we highlighted our team, that is a long track team with also 5-star Morningstar. This is a performance slide. I want just to skip that. the performance is positive against the benchmark, but you can see in more detail, let's say, later. What about the team? This is a very important factor of our company, because the team putting all together all the credit expertise. We do manage 34 billion of asset under management inside credit. We are four teams that sitting side by side is interesting because we put all together the idea. We are 20 credit specialists divided by 4 teams. That is structured credit, high income, where I am, investment grade, and global portfolio. Inside of this team is high income that put together high yield fund, 81 fund, crossover fund. We are 7 of us plus 1 intern. We manage more than 8 billion of asset. We manage this fund and also total return fund, 81 Coco bank fund, and we are splitting this person managing this fund, and also we have special situation analyst, special situation CCC name analyst, let's say. Okay, the management team is a long experienced team. Elena is the fund manager. I'm the portfolio manager, let's talk about the investment process and the portfolio. The portfolio is more than 4 billion of asset under management, and the investment process, of course, is very structured. The top-down analysis, of course, we do have investment committee that decide with us, with all together, all the, let's say, 200 people in the investment department, or maybe a little bit less, put all together the idea to arrive in a top-down allocation, top-down view. But as previously said, where we put a lot of effort in our day-to-day analysis is bottom-up, credit picking. Credit picking because you need a lot of attention, a lot of study for the company, and we study company very in depth, meet management, for example, analyze model, and then of course construct the portfolio with a big attention to the risk. Just to give you an idea of our bottom-up analysis, because it's worth 1 minute, we do have a very in-depth model for our company, because we put a lot of effort for those companies that especially give us more reward. So lower rating company where, let's say, we're trying to find alpha, as previously said, inside also not just lower rating, CCC, a single B, but also the core of the portfolio. But for all the company, we do kind of structure process of bottom-up analysis, of searching company, a big screening inside of the benchmark, so the whole high-yield universe, and then we do fundamental analysis with LBO model and short memo for all the company, and we do have also model for monitoring the process. Just to give you an example, this is kind of an example of due diligence that we do for all the company that we do have an underweight of in the portfolio. We do elaborate a short memo and LBO model with all the key ratio of the balance sheet, putting together with some graph that just give us, we don't just use that for our idea, but give us a very fast view of the company. And then we put all together this data to have an overview of the portfolio. Just to briefly touch the main point of the portfolio, main investment is European high yield. Currency is hedged 100%, but we can have bet on other currency, euro, dollar, sterling name, up to 10% for each currency, but at the end of the day, we hedge the exposure to euro. Diversification, we can put together in the portfolio also hybrid, AT1, and other. And duration, we do have an active bet on duration. So talking about the portfolio right now, what is the situation? We do have an active bet on yield of the portfolio of more than 1%. So the yield of the portfolio right now is like 5.7, more than that. The duration is 2.8, and we have an active spread duration against the benchmark. So of course we have positive also, you can see from the beta of the portfolio that is somewhere, maybe in the next slide. Very important slide, where we are underweighting and where we are overweighted, just to arrive in the conclusion. We really do like banking, and we take exposure in the banking mainly also through AT1, so a little bit of risk there, but also reward. We have an underweight in basic industry, especially in chemicals. It's a very topic name right now with also difficulties, but we think there is a reward there with high beta company, let's say. We have an overweight also in a real estate hybrid and sterling name. What we don't like USD bonds because we think they are kind of not very appealing right now. Overweight also, an underweight, sorry, in Turkish name, in auto, and also in tech and software. This is another topical things right now. Just to arrive in the conclusion, a way to see better our portfolio is not just overweight, underweight, but our bet in terms of option adjusted spread versus the benchmark. Because here you have the bucket of option adjusted spread, here you have the benchmark, and here you have our bet. We are really underweighting the part of very low spread because we think there is no real value there, and we are overweighting all the other bucket of yield, especially also this bucket where more than 500 of spread, where, as previously said, we think there is value being very selectively in credit picking and choosing the best company. So we are overweighting, for example, kind of 4%, this bucket of spread more than 800. That is very, let's say, special situation part of the benchmark. So to conclude, our best ideas. This is the last slide of our presentation. Just to sum up what we told till now, we do prefer Euro high yield market over investment grade and also over US high yield market. We do like diversification because we put in our portfolio also AT1 name and hybrid industrial, because there is opportunity there. In terms of rating, maybe against most of the view, we do like single B against double B, thanks to the carry that is very high, and we need to be very selective in there, inside of single B. And here is kind of searching of alpha. And last but not least, subordination, when there is a name that have both subordination of the bond, we do prefer to stay happy in subordination, so secured instrument over lower instruments. I think this is kind of all for our presentation. So we touch the market, we are positive on the credit right now. And then we arrive to our fund, flagship fund, that is 4 billion asset management, 5-star Morningstar, and we do have an active beta of the portfolio of more of 1.3, and we are positive on the sector that we mentioned. If you have any question? Please.
Robert, fine. Can you give us an example how you use portfolio construction to manage risk?
Yep, sure. Maybe I do have a slide, no? Our approach to the portfolio construction is very, let's say, structured. We do have like a lot of provider that give us the monitoring of risk. Since we are a very big company, we do have also a very big team of risk management that monitoring the position of the fund in a daily basis. But also can do also by ourselves, not just by classical Excel model, but also we do have a provider. For example, we do have Aladdin that give us all the information in a daily basis of the portfolio, of the risk that we have compared to all the limits that the portfolio have. So we monitoring in a daily, hourly basis the risk and the construction of the portfolio. This is.
You move up and down the capital structure then?
Sorry, again?
You move up and down from IG to triple Cs?
More in the sector space. For example, last year we had a strong view on chemical space that were one of the most, let's say, few of the sector that there was like noise. We changed our allocation from short to long, and we changed the construction of the portfolio, removing some other sector to go into this sector. Inside the high yield, we just go up in beta and low in beta. We don't try to move to IG. But if you want, we can elaborate a little bit more because I think we are running out of time. Other question?
One question. You mentioned there secured investment.
Yep.
So secured bonds, a lot depends on the quality of the collateral. How do you guys analyze that?
As previously mentioned, we do have a lot of internal model to see the capital structure here we are talking about. So of each bond, we see both by Bloomberg, by external provider that we do have, and also I had another slide, but we have an external provider that give us balance sheet data standardized for all the company. We take all this data, put all together to elaborate our own model. And this is very useful to compare apple by apple for each company and give us also information on the capital structure of the bond, where to stay up in quality or low in quality. In this right moment, in a general view, we prefer to stay up in subordination inside the same issuer. But then we do select each company, every company have his own detail that we want to elaborate. Other question? No question about the software? Nobody asking about software? Yeah, we are close. Thank you very much.